Welcome back. You're watching Money, 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 and this week we are in conversation with Kaustubh Belapurkar of Morningstar, getting mutual fund ideas for 2019. We've covered the entire equity universe. It's time to talk about fixed income now. And this is a, I think, subject that can go on for an hour in itself, Kaustubh. But broadly speaking, is this going to be a year of duration funds? Should you try and look at playing interest rates because people say interest rates will fall this year? Should you stick to accrual and basically look at high-yielding funds? So,
the street themselves have been a little bit of a quandary in terms of, what rate action RBI is going to be doing. So it's a little bit of a hit and miss there. And if when you speak to the managers, I think what now the expectations really become is that there could be one rate cut, but there's already a pricing in of that in the bond yields. So most of them, while they did make some opportunistic sort of tactical calls on the duration side, not very aggressively, because we've been sitting on low duration for a while, they did take some opportunistic calls in October, November, but have started again, probably still lying a little low on the duration curve. And I think the general expectation is that they won't really go very aggressive on duration till they see clear signs of the interest rate cycle turning around, that start getting into a multiple rate cut sort of cycle. Right now, there's a little bit of a question mark on that. So given that focus, I think for investors, clearly, the focus should be on, looking more on the lower duration side.
Okay.
And clearly, if you have and then you match your investment time horizon with the kind of funds you would want to take. So for instance, if you have just about a 1 year investment horizon, then you should look at something from the ultra short bond or the low duration side.
Okay.
And, we've spoken about two funds here. One's the Kotak Savings Fund.
All right.
Which is clearly on that ultra short bond side, which maintains its duration between 3 to 6 months.
Okay.
Essentially, very, very low interest rate risk. So it just keeps earning the carry on the portfolio. And what it's also done, the manager Deepak Agrawal also maintains about 15 to 20% in sub AAA. When I say sub AAA bonds, he's looking at typically A's and A pluses. So not really going down the credit ladder, but just to, given the yield curve, just to build a little bit of additional kicker in the yields for the portfolio.
So what should I expect if I'm investing in this fund for a year or so? What is the reasonable return expectation?
I would say about 7.5 should be a reasonable sort of kicker that comes in there.
Okay, fair enough. Any other ideas, and how do you find the whole accrual category? Also, a lot of investors who come into fixed income funds do so because the tax advantages start kicking in after 3 years. So for this bucket of investors, what would you advise?
So let me maybe just quickly talk about the other fund that we have, which is Reliance Low Duration for less than a year. So again, very similar strategy to Kotak. Anju, who manages the strategy, again, but it's only in a 6 to 12 month bucket, so slightly higher element of interest rate risk or duration. But again, the portfolio construct's pretty similar. 85% in AAAs and the remaining in AA pluses. So that's fairly straightforward. To answer your question about what do you do for a 3 year perspective, right? And we've kind of given funds from each bucket. So you have an accrual strategy. One, the HDFC Corporate Bond Fund, which is a pure AAA sort of corporate bond portfolio. So, for your very, very risk-averse investors who just want to earn a safe carry of a AAA bond, this is a good strategy to come in. Typically runs a duration between 1 to 3 years. And, like I said, AAA bonds with the majority of the portfolio and a very, very low expense ratio, which is a very important aspect given that, margins are wafer-thin, returns are anyways.
What is the expense ratio?
So this is in the range of about 30-35 basis points.
Oh, wow. That's completely amazing. That's even better than some of the, index funds, etc. that we have out there. And again, what should be the return expectation from something like this?
So again, it'll be in the similar bucket, maybe 25-30 basis points higher than what I mentioned, because you're taking a little bit more of duration risk. The yields are, in excess of 8.5%. So, if you just look at the net yield, would still be in excess of 8% right now.
Okay, so that's one fund. Anything else in the 3 year bucket?
Yes. So then what we've done is, this was for the most conservative investor. Then there's something in between, which is the Aditya Birla Short-Term Opportunities Fund, which does a mix of a portfolio. So it's got about 50-55% in pure AAA sort of bonds. And the remaining, majority of going to AAs, and about 10-15% in single A rated instruments. So what it does, it gives you a yield kicker.
Because you're taking higher credit risk.
Higher credit risk. So the credit risk has gone up. So that's what investors need to understand.
And how much should then the return be higher by, because you are taking more risk?
So you would typically expect maybe a 50 basis points yield kicker on this at least, given where the current spreads lie at, and that's what it would be. So that's really on the short-term opportunities fund. Again, Manish and his team that have been running it excellent, both on duration and credit risk. So, we have an immense amount of comfort that even though they're taking on some credit risk, they know how to manage these kind of strategies really well.
And on your list, I also see the Franklin India Short-Term Fund.
Correct.
Now, where does this fit in?
Yes. So now this fund is an out-and-out sort of credit exposure fund. So if you look at the way Santosh and Kunal, who are the managers of this fund, they're hunting for high-yielding papers. But really, that's where they've built their expertise. Franklin's been one of the pioneers in getting into, investing into the AA, single A sort of spaces. And they've been doing a lot of work around getting new issuers on tap, structuring investments so that, there's enough amount of collateral or, comfort that even if you're getting into a slightly lower rated paper, you're getting a yield that is, which pays off for the risk that you're taking. And that's why this currently, if I look at the yield, it's in excess of 11% on the portfolio.
Wow, this fund is giving you 11%.
Yes. So obviously, because more than 85% of the portfolio is in in double A's and single A's. So then that's where the yield kicker really comes in for the strategy.
So I mean, take your choice, take your pick, and that's why when you're getting into fixed income funds, it is so important to know your time duration of investment and your own risk profile, because 11%, 3 years with the tax advantage sounds like a great deal, but then you should be willing to stomach the volatility that might come along with it.
So I might just correct you here. So it's the gross yield. I mean, just to be on the same page.
All right, that's the gross yield. So the net yield obviously is going to be a couple of basis points lower than that. But anyway, thank you very much, Kaustubh, once again for giving us all of these funds for 2019. That's it on this week's episode of Money, Money, Money. Give us your feedback, comments, queries. Have a great new year. Make lots of money and be efficient with your investments. We'll see you again next week.